Let's talk about Bank of America. Its earnings just grew per share by 34% in a single year. That's true. And it's not the number that tells you what actually happened this quarter. The real story is quieter one, a measure of how efficiently the whole bank turns revenue into profit. And this quarter, it crossed a line it had not crossed in years. Today, we find the numbers and why it matters more than the 34% everyone will quote. I'm Vikas, your host. This is what changed from Wing. We don't chase headlines, we explain what changed. So, before we start, three lines we need to discuss. One is what is the headline, what is the reality, and what is the verdict. So, the headline is earning per share grew 34% year over year to $21. But the reality is, the truest measure of what improved is not the earning jump, it's operating leverage. Revenue grew 15% while costs grew only 8. That gap is the machine getting better. So on this our verdict is this is broad, high quality quarter, honestly. And unusually the headline numbers understated how structural the improvement was. It is really very good improvement. So let's start with that gap because it's the key to the whole quarter. There is a term banks use called operating leverage. It sounds technical, but it's very simple. It's just the difference between how fast your revenue grows and how fast your costs grow. If revenue grows faster than costs, you have positive operating leverage. And it means more of every new dollar you bring in actually reaches profit. Here is the analogy of hold on to. Think of a restaurant. One year it figured out how to send more guests, more tables, more turns without hiring more waiters or opening a second kitchen. Revenue goes up a lot, costs barely move. That restaurants just got more profitable, not because it raised prices, but because it got more efficient. Same building, same staff, more customers served. That's what Bank of America did this quarter. Revenue grew 15% from a year ago. Cost grew only 8. So the gap between them, the operating leverage, came in at 6.6%. And here's why that number matters. Last quarter, that same gap was just 2.9%. So in one quarter, the bank more than doubled the rate at which it's pulling profit ahead of expenses. There is a companion number that says the same thing a different way, the efficiency ratio. That's just how many cents it costs the bank to earn a dollar of revenue. Lower is always a better. So this quarter it came in at just under 59%. The first time it's dropped below 60 in years. A year ago it was above 62. So the restaurant, to keep the analogy going, it now spending about 59 cents to make a dollar, down from 62. That 3 cent improvement across a bank this size is enormous and it's huge. Now, what powered the revenue side? This is where the quarter gets genuinely impressive because it was not one thing. All four of the bank's businesses grew their profit by double digits compared to a year ago. The markets business, the trading desks, was the standout. Profit up 72% with the stock trading part. Equities up 70%. The wealth management arm grew profit 42%. The corporate and investment bank 21. And even the giant consumer bank, checking accounts, credit cards, mortgages grew about 10%. That breadth is the real headline. And when one hot business carries a bank, you worry about what happens when it cools. When all four are growing at once, you are looking at a machine that's working end to end. And underneath of all of it sits the quietest. most important number of all interest income. So that's the money a bank make on the gap between what it earns on loans and what it pays on deposits. This quarter it hit a record $16.2 billion dollars, and it's now risen 5 quarters in a row. That's not a trading windfall that shows up and vanishes. That's the steady compounding engine of bank that holds more than $2 trillion in deposits. This is same story. This big bank, the um, Goldman Sachs, also reported they have also the highest revenue from the trading business this year. So here is why this is more than one good quarter and where the honest question lives. Well, start with the durable part because there's a lot of it. Getting the efficiency ratio below 60% is not a one-time event you can unhappen. Back to the restaurant once you have figured out how to serve more guests with the same staff. That capability stays for longer time, and it does not reset next quarter. The bank is now structurally more profitable per dollar of revenue than it was a year ago, and the return on tangible equity, a core measures of how much profit the bank squeezes from shareholders' money, that is also climbed to 17%, and that's very strong. Now, the forward-looking signals are very good, and the investment banking fees, you talk about the money that bank earns advising on deals and helping companies raise capital, jumped around 50% from a year ago. 50%. Wow. And management said the pipeline of upcoming deals remains very strong. After a long stretch where deal making was frozen, that pipeline refilling is the kind of thing that carries into future quarters, not just this one. Now, where we have to be cautious, and this is the honest one, the single biggest contributor to the beat was the markets business, up 72%, and trading revenue is cyclical. It scales with how volatile and busy markets are, and this quarter markets were busy. That won't be true every quarter. So if you take this quarter's trading result and just paste it into next year's expectations, you will almost certainly be too optimistic. And which is exactly why the other numbers matters more. The record interest income, the sub 60 efficiency ratio, and the refilling deal pipeline, those are the parts that don't depend on markets staying loud. The trading result is the exclamation point, and the efficiency and the interest income are the sentence. One more honest note I want to highlight that record interest income leans partly on older, lower yielding assets rolling over into higher rates. If the Federal Reserve cuts rate faster than expected, that tailwind softens. But I think this case will be not true. Maybe they are planning to hike the rate. I don't know. Maybe. Let's see what FOMC meeting will unfold in coming days. And it's a real variable, and it's one the bank doesn't fully control. So here is where we land today. So last quarter, our what changed read on Bank of America implied a conviction score of 7.2 out of 10. Today, that moves up to 7.9 out of 10. The upgrade is about breadth and durability. This was not one desk having a great 3 months. It was the whole bank getting more efficient with a record in its most stable revenue line and all four businesses growing. What keeps it from scoring higher is the same honest caveat. The loudest single driver was cyclical trading, and the interest income record leans partly on the rate path. Now, that number is not a buy recommendation, not a sell recommendation, just our assessment of how much confidence today's evidence deserves. Three questions that next quarter will answer. We will see closely look that how the business grow and how the market turns the noise into the profits. Well, the first one is, can the efficiency ratio hold below 60%, which is currently at below 60? So we need to closely see the efficiency ratio. And that sub 60 print is the quarter's structural win. Okay. The tell is whether cost discipline holds as the bank keeps investing into technology and people. And number two is what happens to the interest income if rates fall. Uh, well, let's see what happened. The record leans partly on repricing. What we have to watch how the line behaves if the cutting cycle speeds up, or if there is a rate increase, then yes, definitely we are expecting some more surprises in the next quarter. The third one is, does the deal pipeline converts? Whatever they have mentioned that they have the pipelines of deals. So if they converts, then yes, fees up 50% and strong pipeline is the forward signal, the durable offset when trading eventually normalizes. So the real story of Bank of America's quarter is not that earnings grew 34%. It's that the whole machine got measurably more efficient, costs falling as a share of revenue, all four businesses growing, and the steadiest income line hitting a record. Even if its loudest single driver was a trading results that won't repeat every time. Okay, so if you would like to explore every chart, source, and calculation behind today's analysis, you will find the complete research report at wing.io, vyng.io. The link is also in description. Everything is sourced directly from Bank of America's filing because trust is not built by confidence, it's built by transparency. I'm Vikas. This has been What Changed from Wing. We don't report everything, we report what changed. Clarity, not clutter.